China tech stocks defy weak economy to outperform global peers. January 19, 2026. China's tech stocks are surging even as the broader economy struggles. A year after DeepSeek shocked markets with its low-cost AI model, China is entering 2026 with fresh tech breakthroughs and investors largely ignoring weak growth, housing stress, and sluggish consumer spending. A Nasdaq-style index of mainland Chinese tech stocks is up nearly 13% this month, while an index tracking Hong Kong-listed Chinese tech firms has gained about 6%. Both are outperforming the Nasdaq 100, despite persistent economic headwinds. AI boom fuels rally. The rally traces back to January last year, when DeepSeek released an AI model that matched Western peers at a fraction of the cost. The launch rattled global markets and ignited China's AI sector. Since then, companies like Tencent and Alibaba have rapidly adopted generative AI, while smaller firms race to build competing models. Chinese AI is now embedded across industries from robotics and factory equipment to autonomous machines and experimental flying cars. Robots have run marathons, boxed in demos, and performed in public shows, highlighting how quickly the technology is spreading. Manufacturing is also transforming, with AI integrated into precision tools and next-generation machinery. Investors increasingly view China not just as a low-cost manufacturing base, but as a credible rival to U.S. tech. Jefferies tracks 33 Chinese AI stocks whose combined market value has jumped $732 billion over the past year. Even after the surge, Chinese AI firms represent just 6.5% of the market value of U.S. peers, suggesting room for further gains. IPO activity is picking up as well. Recent AI-related listings have posted strong gains, encouraging more companies to go public. Firms in the pipeline include Xpeng's flying car unit, rocket maker Landspace Technology, and Brainco, which some analysts see as a potential rival to Neuralink. Valuations stretch, regulators step in. Rising prices are drawing scrutiny. Cambricon Technologies, an AI chipmaker competing with NVIDIA, trades at roughly 120 times forward earnings. A Chinese robotics index trades near 40 times forward earnings, well above the Nasdaq 100's roughly 25. Beijing has responded by tightening margin financing rules, signaling concern over speculative excess, particularly in tech. Officials appear intent on preventing a bubble. Despite this, some investors remain bullish, citing low labor costs, strong state support, and coordinated industrial policy. Outside tech, the picture remains grim. Upcoming data is expected to confirm weak investment and soft consumer spending, even as exports hold up. Economists surveyed by Bloomberg forecast fourth-quarter GDP growth of 4.5%, the weakest since China reopened after COVID lockdowns. Full-year growth is expected to hit Beijing's 5% target, but deflation means nominal growth may be closer to 4%, one of the slowest paces in decades. ANZ economist Raymond Young warns that a negative GDP deflator signals excess supply and weak demand across the economy. By Cryptopolitan, story by Jai Hamid, January 19, 2026.